Great, thanks very much. Thanks very much for inviting me this morning. Very much appreciate being here to talk to you and your subscribers. I've been asked really to kind of comment on what good governance looks like, I guess in the midst of a pandemic, but probably what does good governance look like full stop, and what lessons have we kind of learned over the years, or the year to date. Little quick introduction about myself if you've never come across me or met myself before. As Jamie said, I'm a partner at MHA Tait Walker. MHA Tait Walker are an accountancy firm based in Newcastle and Gosforth, headquartered there. We employ about 170 or so staff. I head up the not-for-profit team, looking after about 100 or so charities and not-for-profit organisations, with a large team who are specialists in this area, and that's my full-time day job. I look after not-for-profit organisations completely without kind of any for-profit companies on the side. So this is really my area of specialism. I'm a treasurer of a small charity in Newcastle, so have some direct relevant experience of being on a board like trustees, if you yourself are a trustee. So that said, what are we trying to achieve today? So really, I'm trying to look at what good governance does look like, things that you should be watching out for, any potential pressures on the charity's financial health. And I guess a lot of this stuff probably is common sense. And as Jamie mentioned in the introduction there, you've perhaps seen an increase in demand for charitable services, and whilst every charity is different, lots of my charities, say I act for 100, I would say probably 80% have done, 80 or so have done better this year than they've done in past years for a number of reasons. But I think the charity sector always lags the general economy. So I think, if we've got a recession coming, charities tend to feel it behind the curve. So I suspect 21 into 22 and beyond may be more difficult for charities on the basis that the COVID grants, etc., that they may be experienced will kind of dip off while costs come back on fully. Of course, we've had furlough to cover a lot of costs so far. So we've got about 20 minutes or so, and then 10 minutes or so for questions to make up a half-hour slot. And we're going to be looking at clearly what good governance looks like, but we'll look at in detail about meetings. I think understanding the current final position is a key area. We'll cover something called mission drift, and I'll explain what that actually is. Looking at what good controls look like and the environment looks like for good controls. Concerning ourselves with how the pandemic may have impacted those or that good control environment, and then just a little wrap up. So meetings. Meetings are obviously a critical point of any charity, because you've got to really start from, well, what's the structure of a charity? A charity, unlike for-profit businesses, tend to have the non-execs, the directors, the trustees removed from the day-to-day. And in fact, the board, who are ultimately responsible, have obviously had to delegate that responsibility down to management. Now, the key word in there is delegate, or it's not abdicate, it's delegate. So whilst the responsibility stays with the trustees, the day-to-day doesn't. And therefore, there's a communication piece, not only between management and the delivery teams, so a downward delivery to the day-to-day activities. There's clearly an upward communication channel required as well, and that's between the management team and the trustees themselves. And of course, the first thing that happened with the pandemic was that meetings were curtailed, understandably, until we all found our way with Teams or Zoom or Google Hangouts, etc. But what do those meetings look like? The first question, I guess, is, were they allowed? Does your trustee of your charity actually allow you to not physically meet? And that's something that charities possibly overlooked, but it's a small point, but it's an important point. You need to go back to your trustee to make sure that actually the rules allow you to kind of meet in a particular way. And lots of charities have had to update their trustees as a result. But what about AGMs and such like? And there was guidance issued by the Charities Commission as to, what happens if you couldn't physically attend your AGM. You had to kind of make best efforts to kind of get papers out to the board, etc., etc. The key for me on all of this, though, is communication and documentation, particularly. Documenting board decisions, just because they happen virtually doesn't mean you need to stop or detract from the previous minutes that you were holding. But for me, the key thing about minutes is not only documenting the actual decisions reached, but also the conclusion, the thought process, and perhaps the paths that you didn't further explore for various reasons, documenting why decisions weren't taken equally as well as those that were taken. Because anyone can argue with the outcome, but if you tell them the sort of justification, the process of getting there, then they can't really argue with the judgment. So documentation is key. Critically though, I guess understanding the current financial position is hugely important, and you'd expect an accountant to say this. But remember that kind of the fiscal responsibility of the board rests with the board, although, as I say, management have day-to-day responsibility. Now, this for me is a kind of area which is often can be poorly done in terms of receiving regular financial updates from the management team. The board need to be able to see regular information on the performance of the charity, and ever more so in a pandemic, of course, to be able to pivot and respond to any challenges or any down trends in income or costs increasing. Now, often when you see management accounts information, it's often lacking. Sometimes you just see income and expenditure statements and nothing else. And does that give you the whole information? Sometimes charities don't put out balance sheets. Well, a balance sheet by its very name balances, and therefore, if you're only looking at an income and expenditure account, how do you know that the balance sheet is complete and balanced, and that all the expenditure is in the income and expenditure statement and not inadvertently dumped on a balance sheet? So getting all the information is important, but critically getting it at the right time is also important. Information on accounts is always historic, looking back, and therefore you kind of also need to look forward as well. So not only getting historic performance data, but actually looking forward in terms of the projections and the budgets that were set are clearly critical to understand the true financial situation of the charity. So making sure that you've got a good budget set, and then attract actual against budget. So you can compare, well, if income's down, why is it down? If it's up, why is it up? Can you do more of that? Similarly with costs, if costs vary against budget, why? And then you can always question, was the budget appropriate? What actions do we need to take to kind of rectify, to bring ourselves back towards budget? So a lot of this is common sense, but it is very important. The key for me though on a balance sheet is to understand what you're looking at. A balance sheet is a Polaroid picture. It's a snapshot of your organization's finances at one moment in time. And it can be typically every month end, and then ultimately in the annual accounts at the year end. And people tend to get hung up on sort of seeing cash on a balance sheet. So I hope you can see this on your screen, but the cash figure there of £9.5 million, if the left column is the current year and the right column is the previous year, is dropped nearly sort of what, 2.5 million from nearly 12 to 9.5. So at first glance, that looks like that charity has less cash, well, has less cash, but it looks like it's less liquid. However, for me, the pertinent figure on the balance sheet is what's called the net current asset figure. So this figure on the bottom here, which actually takes into account cash, but also adds debtors and takes away current liabilities. Now, my example here is, if you go and plug your personal debit card into your ATM and the hole in the wall, when you first get paid, it all looks rather rosy, and that's the cash at bank figure on a balance sheet. Of course, middle of the month, by the time your direct debits or your mortgage and your car, etc., have taken out, that's really the cash you've got left until you get paid again, and that really represents the net current asset figure. So it takes into account the money's owed to you as well as the money you owe the mortgage company or whoever. So you can see, whilst cash has fallen, in actual fact, net current assets has improved from the previous year, when it was 2.8 million, to the current year, 3.4. So in actual fact, the net current asset position tells a totally different story to the cash position. And that's important to understand. And similarly, in the second example, this charity had no cash at either year end, 74 quid or £300. So at first glance, looks like it's, struggling, and you could argue it is. At a net current asset position, it's actually improved from being underwater last year when it had net liabilities or net current liabilities of 15,000 to having positive net assets of nearly 50,000. So it has improved, although, as you say, at first glance, cash hasn't. But I guess the second point is, what about restricted funds? Because whilst you might have rosy net current assets of £3.5 million, you must take out the restricted funds against that, because restricted funds are monies that you just, if you had to close the doors of your charity today, or at that balance sheet date, restricted funds are those monies you return to the funders straight away and aren't really your funds to kind of close the charity down and get rid of costs. So restricted funds need to come into this sort of factor equation of looking at your net current asset position. We talked about mission drift. What is mission drift? Well, when you set your charity up and you apply to the Charities Commission, you said to them, we're going to do X, Y, and Z to meet one of the 13 purposes of charitable benefit. And this is listed in your trust deed. It's also listed on your accounts in the kind of objectives section of the trustees annual report. But if you're carrying out that purpose, or what we would call primary purpose, that's fine. That's what your charity is set to do. And there may be certain things that you can do that are ancillary to that primary purpose. But what charities often find they get into, particularly during the pandemic, we found more than ever, is they'll grab pots of money, whatever money was available to them, just to kind of stay afloat. And that might include things that aren't in line with your primary purpose or your main objectives. And that's what we call non-primary purpose. And the issue with non-primary purpose is HMRC can tax the charity on the profits of the non-primary purpose where they exceed a kind of de minimis level. And that de minimis level, if your income is over 320,000, is £80,000. Ultimately, it's 25% of your turnover to a maximum of £80,000. Now, let's say you take a theatre, for example. If they have a cafe or a bar, and that bar is open to the public, therefore, it's not directly linked or ancillary to the purposes of the theatre, to go to the charitable theatre and watch a show. If it's open, that cafe or that bar is suddenly competing with Greggs and Subway and whichever bar you care to mention down Grey Street. So suddenly, why should the charity activities in relation to the bar or the cafe not be taxed when Subway, Greggs, etc. are? And that's why there's a limit. The Charities Commission say, okay, you can trade up to £80,000, but you can't trade beyond that unless there's a tax consequence. So charities, when they kind of drift from their mission, could become prone to basically incurring tax. So that's something to kind of watch out for. And of course, there are other issues of mission drift in respect of VAT. Charities aren't immune to VAT, and some have a taxable activity and pay VAT. But again, if you start to do different things and you suddenly start grabbing pots of money outside of grants, potentially you could attract or be liable for that. And if you don't recognise that at day one, you could be building up a liability there. Tax, as I say, is linked to the non-primary purpose trading, so watch out for that. But I guess the other thing to watch out for, which is a bit sort of less tangible, is reputation. If you're a charity doing X and you suddenly do Y, have you got the skill sets within your charity to do Y? And if not, what are you risking? You know, potentially if it all goes wrong, you're risking a headline in the Chronicle or somewhere like that. And that's something you don't want to do, because, you know, reputations are hard earned but lost in a second. And also the strategy, if the management team are definitely grabbing pots of money, is that in line with the board's authorised strategy? Because remember, the board ultimately are responsible. And, you know, has that been approved at a board meeting? I guess you pivot back to the point where we started about meetings. Does the strategy meet, or is the strategy approved, and has it been approved and documented at the meetings? So I guess, what does a good control environment look like? And again, this is not anything other than common sense. Clearly, the diagram shows that as a board of trustees, having delegated down to the management team, you've got basically a system, if you like, is that dotted circle almost is the kind of systems controls environment in which that delegation takes place. Because without a system and control, or agreed systems and controls, the board can't delegate to the management team, because they don't know that if those systems controls are otherwise not followed, then you know, how would they know that the result would be as they want it? So having the agreed systems and controls is fundamentally vital, really, to the kind of successful operation of that delegation. But I guess the key questions are, when were the controls formulated? how long ago? Because are they still fit for purpose today? And I kind of reiterate that with the pandemic and working from home. Are those controls still being followed? When were they written? When were they written? Are they written down? If they're not written down and documented, do they even exist? So understanding what those key controls are, particularly for a board member, is vital. And the critical thing I always say to my clients, my charity clients, are when the last time you tested the controls, don't rely on me as auditor. That's not my job. I'll test the key controls as part of your audit once a year, but that's the key controls. You as trustees should be testing the controls at least once a year. And that, as I said, I'm a treasurer of a small building preservation trust charity, and it falls to me as treasurer to go and test those controls, because that's the basis on which we as trustees delegate the day-to-day activities to the management team. So make sure that you do test them regularly. And why are controls there? Well, the obvious one is right at the top there, to protect the charity's finances and money. The less obvious ones are things like protecting the charity's data. And depending on the type of charity you are, you might have some sensitive personal data in there about minors, children, sexual orientation, ethnicity, etc., etc. There could be some key GDPR issues in there, so protection of data is vitally important. Mentioned already the protection of the reputation of the charity, but I guess the protection of your people as well. If people are your key asset, which they often are, then protect them, stopping them from allowing them to do daft things, to, allowing them to kind of have opportunity to kind of defraud is also protecting them. So controls help protect people. What does a good control look like? Well, for me, the broad principles are across the columns at the top. So safeguarding an asset or whatever, protecting it and securing it. Safeguard, protect and secure are the key broad principles. And I guess the steps that we take to kind of carry out those broad principles, if we picked on, say, an example of getting cost into the charity, a purchase invoice. So the safeguard is to set an expectation, and that expectation would be, the control would be raising a purchase order, so that someone's authorised you to go out and buy something. So we've got a purchase order. The protect broad principle, otherwise checking, is to then check that purchase order against the purchase invoice when it comes in. That's a good sound control. And then the secure, or the review bit, is to kind of look back and have a second person effectively check that the purchase order and the purchase invoice match, and then authorize it prior to payment. So that's a good control environment there. There's other good examples where you've got, pick on one there, there's a number down the left-hand side. I guess data is the less obvious one, where, the expectation is, well, who's got access to the data? How do we safeguard it? Are we making sure it's not a risk of loss? The check is, well, where is it stored? And is it still stored in the same place we thought it was when everyone's been working from home? Do we have the security of that data in terms of a backup? And the review, is it still fit for purpose? Have we made any changes? I mentioned what's called a DPIA form, which those who are particularly clued in with the GDPR will recognise that as a data protection impact assessment form. So where you've changed your control, i.e. someone might work from home now, and therefore, whereas you physically scribed on an invoice to kind of authorise it, you maybe are now doing that by email. I think the GDPR, the ICO, the Commissioner's Office DPIA forms give you a good basis to kind of check any changes you make to systems, because it gets you to think, well, what's changed? Does it still protect the data? And if not, why not? Or what could we do better? There's lots of examples on there, bank statements, bank payments being another one, and the kind of dual authorization of bank payments, I guess, is the ultimate control of stopping money leave the bank. And I guess just sort of finally on this screen, remote systems, as I say, working from home during the pandemic, are the systems still being followed? And I guess if you're not already testing your systems, you should start doing that, because that's a critical responsibility. But revisit that under working from home, document them if they're not already documented, to make sure that they are actually working. Of course, there has been increased opportunity for fraud and error, because without sitting next to someone in an office, fraud was to occur, and we have seen it occur during the pandemic, the opportunities increased working from home. But also, because of kind of remote communications, the risk heightens for fraud to occur because of hackers or IT issues. The typical CEO fraud in the office, where you get that urgent email from your boss saying, please pay this, I'm on the phone, do it now, often doesn't work in the office, but it could work at home if you're isolated and you receive an email. So, just check for remote systems, make sure that you've got a strong control environment. I've got I'm conscious that we're just beyond the 20 minutes now and that we've got time for questions, but I've got a number of areas where I have seen fraud happen over the past 12 months particularly, and a bit longer. Standing data changes is a critical area. If you receive an email that says don't pay the normal bank account, pay this new one, everyone would think, well, I'm not going to fall for that. But I have seen charities fall for that. And standing data was changed without someone picking up the phone to ring the client and say, can I just check the email you sent asking us to change the details is valid. Remote desktops, I have seen hackers access personal email addresses for charity trustees, where they've then gone on to use the information in those personal email inboxes to kind of perpetrate a fraud. So again, try and tie your systems down, make sure that you pick up the phone to check things. And I have seen an instance where, to overcome the impracticalities of the dual authorization on checks, which is a key control, they decided that they would just countersign a load of blank checks to make it easy, so that when the expenditure was requested, the single signatory could just go ahead there. But again, you're overriding key control. So, there's lots of things to think about having work from home. The pandemic has caused issues, but I think lots of charities have done well this year, and we just need to make sure we preserve that into the future.
Some question here about business rate grants. How do you treat the business rate grants from the government? Are they classed as unrestricted, and are they classed as taxable?
Yeah. Okay. So yeah, lots of businesses have received various sort of incentives or relief grants. The particular one there about the business rates grant from the government it would be classed as unrestricted, because effectively it's money given freely without any sort of restricted purpose. And when grants are restricted, it's the donor saying to the charity, you must do X, Y, or Z with the money. That creates the restriction of purpose, and therefore can only be spent on that particular purpose. In this case, they're giving you the effectively, or they're relieving you from having to pay the rates grant, so therefore it is unrestricted. Many charities didn't pay business rates anyway. Lots of them got the 80% mandatory relief. There was often you got the 20% additional relief direct from the council. So lots of charities already had that. So definitely unrestricted. Are they classed as taxable? No. They are a grant as opposed to kind of trading activity. So they wouldn't be taxable, and they wouldn't count towards your £80,000 de minimis limit.
Great, thanks, Simon. Another question here. The limit of 80,000, is that in total across all income generation activities, or could it be bracketed for things such as room hire, coffee, bar income, service delivery, etc.?
Yeah, okay, so the £80,000 de minimis limit is in respect of all non-primary purpose trade. So if your primary purpose is to, the classic example being the theatre, to carry out theatre services, if you then suddenly have, say, a cafe, some room hire, because you might hire out costs of the theatre for weddings, parties and such like, that arguably is not in line with your primary purpose objectives. So all of those non-primary purposes, you top up together. So if, say, the cafe was 50,000 and then room hire was 20, then you had bar of 10 and such off. As soon as you go above 80 with all of those, it's £80,001, all £80,000 becomes taxable. But remember, it's only the profits that are taxable, not the turnover. So the bar that you kind of measure yourself against is turnover. But then once you're above the bar, you disregard the turnover and you go, well, what's our profits of those? And if you've made a loss, you still don't pay any tax. But if you made a big profit or any profit, then potentially you are liable to tax. If you're 79,999 underneath the bar, then you're under the bar and you don't have to think about what the profits are. So yes, all non-primary purpose income generation activities would be measured in total.
Thanks, Alan, that's really clear. Another question, are charities liable for corporation tax? I realise this is not entirely relevant, but I'm looking for board, directors, trustees, but being a charity, there's little interest, there's no payment, only expenses. Our governance has been good. Do you have any suggestions of where to look?
Well, yes. I mean, the way I always explain it is, imagine a charity as a legal entity, as a box, or those post-it notes. What charity really means is a bubble that kind of goes around the legal entity. So companies are legal entities, just like your charity is, and they're subject to tax. But because you're a registered charity, you get this bubble of protection around. Now that bubble stops you from paying tax. Now the things that can prick the bubble are the non-primary purpose trading things that we talked about, and therefore the charity is only liable to tax should you prick the bubble and partially burst the bubble. And again, we go back to the previous question about the £80,000 limit, and that's the bit that would become liable to tax. So the charity isn't liable for tax per se, it's only if you pierce the bubble and do non-trading trading activities, non-primary purpose activities.
Great, and I think the sort of the second part of that was saying that not necessarily relevant to the talk today, but in terms of board directors and trustees, because of they can only pay expenses. We're going to maybe look for some good candidates.
Yeah. You can pay trustees' expenses. Again, you need to check your governing documents to see whether you're allowed to do that. But assuming there's nothing in there to stop you doing that, you can pay boards of directors. You can't pay them for being a trustee because it isn't a paid post, but you can pay them where they do work for the charity that you would otherwise have to go out and procure. And again, if you're looking to pay trustees for, say, you've got an accountant on the board who wants to do the examination or who wants to help you prepare the finances, or maybe you've got a painter and decorator on there who wants to paint your premises for you, as long as you've procured tenders to say, well, what's the market rate for those services, and the trustee is doing those services for at less than market rate, then you can pay them. In terms of where you find trustees, that's the overall, the question. Good trustees are hard to find, but there are places you can go to.
And one last question. It's based for clarity. Primary purposes are those listed in Amendment R under objects of the charity. Basically, is that correct?
Correct. And if you found that because of mission drift, you've kind of gone outside of those and you intend to stay outside of them, you can change your articles and memorandums of the Charities Commission to kind of incorporate or make your articles and objectives wider, so that you're now covering the things that were previously non-primary purpose. Of course, you can't widen them so wide that you then start to compete against for-profit businesses. There still have to be a charitable objective within your widening, but assuming you are still carrying out a charitable objective, and it might have been, for example, it might have been that you might do your services in the north, and now you want to kind of just make your services generally available across all regions, or it might be to do with a particular type of service where you just want to open it up again. You can do that. You can amend and lots of charities have in the past 12 months. And of course, they can speak to lawyers if they need any help.
Of course, excellent. Thank